been doing this for 14 years. And the first 10 years, I have done a classical finance, managed treasury, mostly treasury and corporate finance, managed cash for industrial groups, European, German industrial groups. And during the last 4 days, I have changed, 4 years ago, I changed into the fintech business, and I have been doing this for 4 years already. But this will not be the topic of our discussion. The topic will be liquidity management for startups. And let's, before we start, I would like to ask you, who of you has already had some experience in managing finances, managing liquidity? This is just for me to understand the level of your proficiency here. Does somebody managed liquidity or finances in the past? This is my question to the group. So no, not yet. No. So I presume nobody has managed it before. But we will start very simple then. We'll start very simple. This is rather complicated matter, but if you break down it into details, so you will be easily capable to manage it. So let's start. We are starting with 3 questions. When we are thinking about creating a startup or diving into the startup business or into business activities, which questions do we ask? Which topics do we need to encounter? This is about increasing sales with incentives and promotions, which actually will not, this is very important, but will not be the issue for today or topic for today. Rather the 2 later questions will be the topic. Keep close eye on the cash flow. This is what we will be doing, and plan everything ahead. This is what we will be doing as well.
Anton, so, one moment. You please share your screen, because we cannot see your slides yet. You have to do it.
Wait a minute.
You have to do it again.
Share my screen.
Yeah.
This is. Oh, sorry for that. I share my screen.
Yes. Now we can see it.
So now this is the first page. So this is the second page. You haven't missed anything. No worries. So we'll be looking into cash flow, and we will be looking into planning, financial plans as well. So wait a minute, I need to switch. Yeah, in theory, there is a point of view that in theory you are actually able to plan everything ahead. Yeah, surely you are. With help of the financial theory, you are capable of planning things, a lot of things ahead. But there are things you cannot plan ahead, because you don't know if they occur or if they take place in the future. This is actually one of the biggest impacts of the Keynesian theory. So the future is different from the past, because not only the events are in the past and not known yet, but also the reasons of those events are not known, are in the future and not known yet. And since we are talking about economic things, so this is about people doing business with each other, going into agreements with each other, and nobody knows if those agreements will take place in the future. So this is the social events and economic events is actually different from the natural events. When we know all reasons, so all causes, if we know all causes, so all effects will follow. This is not actually the case for the social events, because people deal with conflicts and with agreements and with common actions all the time, and all the time they are they have different results. So we cannot be sure of anything. This is what I wanted to tell you about uncertainty. So if we go to the next slide, this is what we're talking about. So every startup starts with a financial plan. If you don't have a financial plan, no investor, no angel, nobody will be even talking to you. So you need to be able to draw up a financial plan. People who are acquainted with accounting and bookkeeping, they will probably the most common form of this is actually a P&L, the profit and loss statement, which I will be showing you a little later. And this profit and loss statement, this includes all your sales, all your revenue, and all your expenses, actually. This is your major document, which is with stretches in the future into some years, 3 to 5 years, actually. Based on this document, you are creating your liquidity management tool, your cash flow statement. This is your central document within the framework of the cash management. So your financial plan is the source of your liquidity plan. This is important. And your liquidity plan is actually the source of your daily cash management, because liquidity plan is actually a monthly overview, and you're supposed to do payments and receive cash on a daily basis. So I will be showing you later how this takes place. I would like to mention actually that there are 2 types of liquidity of cash flow statements. The first type of cash flow statement is derived from the financial plan. So you have a financial plan, you do some adjustments, and you have your cash flow statements. This is called an indirect method. This is one thing. And there is another thing. Your direct cash flow statement comes from your bank statement, so from your actual payments you do. So keep in mind those 2 types, because I will come back to those on the later stage. So we go to the next slide. Probably you have some question now, so please raise your hand. Nobody raises a hand, so I go further. Financial plan. As I told you, without a financial plan, nothing goes without a financial plan. And you are at the beginning, you are capable of, you need to be capable of drawing a financial plan, because this is the central document your investors, your angel investors are looking into. Because from your perspective, your company is your baby. This is what you love it. You think about it day and night. And for the investors, this is just an investment opportunity. This is an investment object. They need to have something objective. So to be able to calculate the losses and profits and so you need to have a financial plan. But the financial plan, there are ways there are difficulties, I would say, like a picture says. So at the beginning, you think you might be able to create a straightforward finance plan, but in reality, is much more complicated. But there are, as I told you, there are things you can know in advance, and there are things you cannot possibly know in advance. So keep this in mind, and this uncertainty needs to go down, to break down into you, to find a reflection in your financial plan and in your cash management tool and liquidity plan as well. So we go to the next slide. The way to create to start a business, you need to figure out several things. This is pretty useful if you look at your competitors, so you know what they are doing. There is nothing new in the world. So even so I spent last years in the fintech business thinking, so ideas we are realizing were really unique, but this is not the case. So like there is always somebody who's capable of creating something similar. So this is you need to look into your competitors pretty detailed to get a pretty detailed understanding of what they are doing. This is important. Then it's important financial plan, but we talked already about financial plan. This is really the A and O of your startup business activities, because nobody, as I told you, nobody will talk to you if you don't have a finance plan. A strategy, not forever is not a guarantee of success. So the idea is you need to be able to change it. You need to be able to change it because from your financial plan includes your revenue, so your sales, the cash you get for your business activities. In the future, since this is all in the future, there might be things which take place and which deter you from having this revenue. So you need to be able to adjust your financial plan as well. But this is actually obvious. The most complicated thing is when your expenses grow in a way you have never anticipated. This is a much better, much worse and much more serious issue, but we will need to look into this at a later stage. Wait a minute. And if you have planned, if you have created a financial plan and you see that the real economic reality, real economic relationships, they differ from your plan above 20%. I don't know if it is 20% or not, but it should be. So if there is a significant discrepancy, you need to think ahead. You need to do it again and just start from the beginning, because this might lead to serious issues in the future. So we go to the next slide. Liquidity management. How much liquidity is a good liquidity? So it's too much, too few. So basically, there is no such thing as enough liquidity, because if you have too much cash rich, if you are cash rich and you have too much, it means you have too much cash. But I have never seen any startup who had too much liquidity, really. So it's always an issue of a lack of liquidity, always an issue of not having enough liquidity. So, but basically in theory, so if it lies around and it doesn't bring you any revenue, you just lose opportunities. But at the beginning, at least at the beginning, there is I've never seen a startup which had a too much of liquidity, really. So too little liquidity, this is the case which happens much more often. And if you don't have enough, you need to postpone some payments, which will lead to some extra fees. So you need to have some extra cost of borrowing. You need to encounter to lose some customers. You need to lose some suppliers, not customers, suppliers, and probably you will lose some business opportunities. So this is very important to have at least liquidity, which gives you a chance to go concert, to keep going with your business. This is very important. That's why we're talking about liquidity, actually. So we go to the next slide, and this is how the steps, how your startup looks like. So the first is an idea. If you have an idea, you need to have a finance plan, as I told you, because with no finance plan, no investor will talk to you. Then with a viable finance plan, which gives an understanding for the business angels and for the accelerators and first investors of what kind of profit they will get with your business project. With this, you can try to get some first investment. Basically, this comes from the fellow businessman, from friends, from family, and this is what you get your first money from. Yeah, and at the later stage, if the banks are or other financial institutions are in play, they will always look into three things, or mainly three things. Do you have a viable product? So are you capable of creating a marketable product? Do you have users? Do you have clients who are willing to purchase it? And have you ever produced a positive revenue? These three things are important. So you need to keep this in mind if you go to, before you go to the investors to talk about investments into your project. So we'll go further. Yeah, and in the first stages, what kinds of liquidity, what kinds of financing you can get. The first is the sale of shares, but this is usually for co-founders, people who are willing to do this business, who are willing to exercise control of the business. So they are willing to control the equity, and probably some angel investor who is willing to give the first investment, to draw the first investment. So he usually gets, I don't know, 5-10% of the shares, and the rest is divided among the co-founders, because co-founders are willing to always to control the business, because this is why you are doing this. This is why you are doing this. You are doing this to make profits, to prosper, and to control the business. And this is about controlling your business. Yeah. The second most interesting financial instrument at this stage might be a convertible loan. So what is a convertible loan? As the name says already, there are people willing to invest, to give you a loan, which will, at the later stage, will be converted into the share. So like there will be share redistribution process based on this, and you will be needing to issue some more shares and to change the percentage of shares in your possession with regard to the possession of others. But I will talk about this in the second stage as well. The next page is this is about cash flow. The cash flow statement. The cash flow statement is actually happening on the daily basis. So because this is on the daily basis that you are getting some cash from your sales, or you are paying invoices and paying some other, doing some other expenses in order to keep going as a business. It should be, the cash flow statement should allow you to do it on a daily basis. This is what you need a special tool for, a special, probably a software tool, which allows you to do this on the daily basis, to control it on the daily basis, because you have a financial plan is on the yearly basis. You have a liquidity plan is on the monthly basis, and your cash flow activities, these are on the daily basis. So this is important to know. If you do not, if you're not able to control your expenses, so you don't have a plan. So you don't need a plan, actually. You need a plan to control your expenses. So if you just draw a plan and then do not consult it anymore during your business, the plan doesn't have any importance to you. And since you do not follow your plan anymore, your investors will, which based their investment activities based on this financial plan, they will ask you why you don't control, why you don't have your financial activities under control. So you need to to do the comparison. You need to do the reconciliation all the time. So this is what I will show you with my Excel sheet I've created for this purpose. So basically, you need to be in control of your finances. So you need to be able to control your actual spendings or actual financial flows with your plan. This is important. Yeah. So if you don't do this, these things can happen to you. So you delay your launch of your product. You have a liquidity gap. What is a liquidity gap? You have more expenses than you have in cash available, so you cannot do any payments anymore. So this is actually the liquidity gap. So if you can't do this, you cannot do business anymore. So this is what is sold on in the third line as well. So this is important. Not enough cash. This can end very badly for you. So we'll do with those scenarios. Before we do those scenarios, I would like to introduce a simple Excel-based financial plan, followed by the liquidity plan. So let's do it. This is the financial plan I've created. So this is a generic financial plan I've created just to give you an idea, to make you understand what are we talking about. So in this line, the first line, line number 5, we see our sales. So the sales, this is the cash coming into the company. This is the product you've created and brought to the market. So I've done a little increase here. So like there is an increase of 5% from month to month to this, but basically the your total revenue minus your total expenses makes out your financial plan, which is created in form of profit and loss statements. So basically, this is can be done into up to 3-5 years, but I've done it on the you can actually break down it also on the monthly basis in order to be able to create a cash flow statement out of it. So so your sales, this is money coming into your business, and there are different types of expenses. So the first type of expense is cost of goods sold or cost of service. So these are materials which you use to create your product. They go into the price of the product. They need to be subtracted as first. Actually, since I'm working for fintech companies, so there is actually no such thing as cost of goods sold already. So nobody is maintaining an inventory, not technological companies, because technology companies, this is all about software, this is all about programming, and this is actually services they are getting, not the product or not the inventory. But it can be named as we like. So services are more for the financial fintech companies, and goods sold are more for the traditional ones. So after this, you need to do some marketing expenses. So you need to people know about your product and about your project as well, actually. So these are I've made an assumption of 2% increase over the months, and cost of goods sold, cost of services is 3% of increase over the months. So like you see it on in the table. The personal costs are the most important. So if you can't pay salaries, you will be out of business pretty quickly, because in Germany especially, this is one of the most regulated types of expenses. So the employees are very protected by the law, by the state. So you cannot just not pay salaries. This will never happen. So you will be out of business very often. And I had, in my personal experience, I was running companies who were in lack of money. And I tried to create this time, I tried to create a contingency plan. Contingency plan is what plan, this is a crisis management. So what do you have to pay to keep going with the business? And this was at the first place, these were salaries and payroll tax and social security and health insurance and payments related to this. All other can wait. Probably rent costs. Yeah, you need to have an office. Yeah, but the rest is up to the crisis to decide. And somehow, if you are capable of designing this contingency plan, you are capable of surmounting those difficulties, financial difficulties you have. And here we see general costs. We see many office rent, office material. You will be seeing it in the third part as well, when I will be presenting a short video with the software we are thinking is most suitable to do the cash flow management for you. These are most common expenses, types of expenses a business runs. It's like freelancers, if you need some designers to design, legal, you always need a legal, if you go to the new market, you need to understand the legal situation on the market. Tax advisory, yeah, so if you don't book your salary, or if you don't book a payroll, and if you don't do your accounting yourself, so you need to hire tax advisory. Software licenses, everybody needs a software, and everybody needs some licenses, and communication, this is about internet, phones, and so on. And then after you subtracted all this from your, you remember, we were at the beginning, we were here with sales. This is a positive number, and all these numbers are negative. So they are subtracted from your revenue, and now your margin is actually negative already. You wouldn't be, that means you wouldn't be able to pay your business out of your sales. If you hadn't, if you had no financial activities, you wouldn't be able to do this. So we will be looking at those activities as financial activities as well, which are required in this case to keep going with your business. Since this is not a cash flow statement, this is a financial plan in form of a profit and loss statement. So you need to account for every expenses you are having in the period of time. No importance if you pay them or if you don't pay them. This is not these two, for example. These are non-cash items, so-called non-cash items. So if you have fixed assets, computers, for example, PCs, or some monitors or some equipment, you need to, this is actually a fixed asset. Equipment, office equipment up to beginning with 800 euros is actually a fixed asset. You need to do a depreciation of the fixed assets, following the pretty simple truth that over the time, your fixed assets, your product, or the objects you use as computers, they just lose in value. And in order to take account of this loss in value, you need to do depreciation and amortization. This is the same actually happens with intangibles, with software, with goodwill. If you have a goodwill, this is the special position your company has at the market. So this is nothing material, but because of this position, you get actually some additional revenue. You are able to do business, and this fades over the time as well. So you need to do depreciation on this as well. And both of these are non-cash item. That means you don't pay those, they are just calculated. As for tax advisory, legal advisory, freelancer, you really pay them. You really pay them every month. And those two, they are just for financial calculations there, just to reflect the truth that your computer lose in value. We go further and we come to the financial and income expenses. As we saw, our revenue is not enough. Our revenue is 220,000 a month. This is not enough to cover all our expenses. So we need to switch on some financial activities. So like to take money from somebody in order to keep going with our business. And these are expenses for those for the loans we will be taking. But two of those, so there are three types of loans: convertible loans, as I told you, so loans which will be converted into the shares capital, into the share capital in the future, and shareholders loans. So like the shareholders, the owners of the company as private persons are giving to the company, are giving actually to themselves, are giving themselves a loan as an owner of the business. And most probably both of those loans and the interest on both of those loans are not paid, because a shareholder will not pay himself an interest. And convertible loan is the reason of this is to be converted into the shares. So they want to get as much so much shares as they want, as they get. So they don't want interest to be paid anyway. So that's why these both of these are not non-cash items. They will not be paid in reality. They will be just calculated, because you got an investment, you need to pay an interest on this. So it needs to be calculated, but it will never be paid. But the third type, this is actually what we will be talking about into the third stage of our today's course. This will be a loan from the third party, and this loan will be paid, will really be paid, will really be entering the cash flow statement. So, and after we subtract all these things, we come to the net profit. So net profit, once again, net profit is your revenue minus all these costs you have, including the costs you pay as the freelancers, as advertising, also including those you do not pay. This is a difference between the profit and loss statement or financial plan and cash flow statements, because the cash flow statement only includes items you pay, you really pay. Cash flow is about payments. Financial plan is about keeping your revenue and expenses under control and being able to reflect them into the right period of time. So they need to be noticed and indicated in the period they really have taken place. This is important. That's why we are dealing with those non-cash items, which we will be needing to add back, since in the cash flow statement there is no such thing as a non-cash item. So we came to the net profit, since we EBT is just earnings before taxes. So since we are I made an assumption, since we are non-profitable yet, so our expenses are bigger than our revenue, so we don't pay a tax. So that's why this is net profit, is the end line of our financial plan and is actually the beginning line of our cash flow statement. And this cash flow statement, so we will be able to reconstruct the cash flow statement out of the financial plan. We need this, again, we need these cash flow statements to understand our real payments. The financial plan gives us an understanding and gives our investors an understanding of what will be the revenue, what will be expenses over the time, over the bigger lapses of time, 3 or 5 years. And our cash flow statement gives us an understanding what will be paid. So we need to be, since those two things need to be connected to each other, otherwise we will never be able to control any business. So we need to, there is a way to construct the cash flow statements out of profits, out of financial statements, out of a profit and loss statement. So what are we doing? You saw here our revenue. Revenue comes to our account. Nothing wrong with this. All these costs of goods sold, marketing, salaries, all these will be really paid in this month. So there is nothing wrong with that. We don't have to do anything, but they can go into the cash flow statement with no changes. But those two, we have never paid those two. So we need to add them back because they are not, they are in the profit and loss statement, but they are not in the cash flow statements because these are just calculatory expenses. They have never been paid to reflect the idea that your fixed assets, they just lose in value over the time. So we'll need to add them back. So yeah, and probably another thing to tell you, your cash flow statement is actually structured into three parts: the operational, investment, and financial. Your operational activities, daily activities, selling of your products or paying of your freelancers, this is operational activities. The investment activities is if the company decides to purchase some additional fixed assets, some more computers, some more probably plants and equipment, and so. Financial activities, financial part of the cash flow statements is where you get your money from. This is the relationship with shareholders and investors. So basically, you need to understand those two items which need to be added back to reflect the real cash flow statement. We need to put them, since these are related to fixed assets, we need to put them into investment cash flow. So we add them back, but on the right place. We add them back on the investment cash flow statements. There is such a thing as inventory. There is such a thing as a working capital. So if you are producing some material objects to be sold, you need to input some other stuff into it. So this is building your inventory, and you need to be able of calculating your inventory. And then the inventory makes your assets, was one of your assets. So when you produce your product, you just use and reduce your inventory, but inventory becomes smaller, and the products to be sold becomes bigger. Actually, the amount of those becomes bigger because it's out of the inventory that it's created. This is the first part. The second line is accounts receivable. People with accounting knowledge would understand what account receivable is. Account receivable is you can let your customers pay your product at once. So I give you my product now, you give me your money now. And I can do a delay also. I can give you my product now, but you can pay within 2 weeks. So those not yet paid, but sold already, products paid, not paid, but sold already, they build the accounts receivable. Accruals, this is the similar logic, but probably some other stuff to consider. Here, you need to understand. So if your inventory goes bigger, that means you spend cash. That means your cash becomes smaller. The bigger your inventory, the smaller is your cash. The relationship is not direct, but opposite direction. They go in opposite direction. Inventory goes up, your cash goes down. That's why the up in inventory is reflected as minus in cash. Accounts receivable. So you allow people to pay you later. This is also actually amount of cash you don't get now. You get some in some future time. And if you get some, you get paid, but your product is not made yet. So you sell your product in the future, but you get paid yet. You get paid now. So that means your money, your cash is increasing. So that's why if your inventory is growing, your cash is down. If your accounts receivable is growing, your cash is down. If your prepaid revenue, if you pre-sold some of your products, your cash is up because you got money now, and your product, you will be delivering it later. This is the asset side. The liability side is goes in the other direction. So prepayments. If the people, if you you need to pay it later, you get some stuff now, but you paid later. So this is this is the position. What is the position is all about? So you need to understand if you get paid later, if you need to pay it later, that means some additional money is coming in. So if it increases, so if it decreases, you get a minus. If it increases, you get a plus. Actually, the accounts payable is things you need to pay. You got the service, but you haven't paid it yet. So you need to, this is additional cash for you. If you are able to pay something later, this is always better to your present use of cash because you have more, as if you had to pay it at once. So if your accounts payable increase, the amount of cash at your disposal increases as well. Deferrals, this is as well. This is the position when you have to pay later for something you get now. So this is pretty similar to the former line. And now your working capital, add the sum of your working capital. You need to you work with this. So like assets give your use of cash, and your passive or liability side gives your source of cash. This is important. This is important for the cash flow statements because you need to pay for the inventory, you need to pay for the accounts receivable, and changes in those positions influence your cash position at the moment. So and we need to. This was the operational cash flow. Operational cash flow statement is then produced. Operational cash flow statements includes disbursements and money receipts from your business activities. So I talked about investment cash flow. Since those are non-cash items, they need to be added back to the cash flow statement because otherwise they will be missed. Otherwise, the cash flow statement will not reflect your move of money. And now we need to look into the financial cash flow. Financial cash flow, this is the source of your funds. So you have equity capital, which is in Germany actually 25,000 euros. And you need to pay it in before you do the business. And then convertible loans. As I told you already, convertible loans are most probably some friends or some business partners are giving those to you. They give you a loan, but willing to change it into the shares in the future. That's why they don't pay. They don't want your interest to be paid. They want it just to be accumulated and exchange it into shares. So this is that's why it's called here. I put it non-cash. So like these interest on those convertible loans, these will never be paid. So that's why you need to pay. You need to put it back. So you have subtracted it from the P&L because those expenses, they have really taken place. Meaning that you owe those things to somebody. You haven't paid them, but you owe them to somebody. So, but since they haven't been paid, you need to add these back here. And the same with the shareholders' loans. the shareholders' loans, this is when the business owners are giving to themselves. They also don't want them to be paid back. So you need to add them back to the cash flow statements. But the third part, the loans you are getting from the third parties, they need to be put here, and they will be subtracted. The interest will be subtracted from your cash flow statements. This is, and now we are at the end of our indirect method of creating the cash flow statement. If you see it here, I just wait a minute. I need to put it right. I need to do it this way. So your cash flow statements after the indirect method will be the same. It doesn't work. Somehow it doesn't work. Will be the same. This is not the best way to show it. Will be the same. You see, the numbers are the same. Will be the same as your cash flow statement created after the direct method. But the direct method is actually something totally different, because it's created from the bank statements and not from the financial plans. So, and to see here, we are at the end of our indirect cash flow statements, and we need to create the cash flow statement in order to compare our plan with actual payments. We need to create a cash flow statement from the direct method. Direct method, that means from the bank account. So like it analyzes, and the statement is created from all past transactions which you get from your bank. So you paid salaries, you paid office rent for several months. All these goes into this statement. But the difference, it also goes into the form statements as well. But the difference is, since your profit and loss statement is net, so there is no VAT on this, and the payments you are doing, the invoices you're getting, they include the VAT, and you are paying those invoices with VAT. There will be always a difference between the cash flow statement created under the indirect method and cash flow statement created under the direct method. So there will be 19% difference in Germany for most of the VAT for the most of the products and services. So, and here you see the same cash flow statement, the same positions, sales 20,000. And since sales are in actual sales take place as a gross, so you need to add 19% on this. So there will be discrepancy in between the plan and the actual. The same with cost of goods sold. We had cost of goods sold here at the beginning. Wait a minute, we had it here at the beginning. We have the same here. But the only difference is they are paid with VAT. So there is a difference in VAT. You see, 19% on 10 is 1,900. Marketing, the same picture. We had it at the beginning. We had it as a plan because we need something to be compared to our actuals. So there is a difference of VAT. Salaries do not have VAT, payroll and social security doesn't have VAT, but all the rest has a VAT. So you need to look into this and to your VAT. And this creates, this creates your cash flow, operational cash flow position, and then you. Since the cash flow, operational cash flow position is already done, you need to do the investment cash flow as well. And you remember those paid in capital, the convertible loans you get, but you don't get the interest for those because nobody pays them. So the convertible loan is not, there is no interest paid on the convertible, most probably. So there are cases it is, but most probably it's not. And there is no interest here on the convertible loans. There is no interest here on the shareholders loan as well, because they also, if the founder of the company gives himself amount of money, he doesn't pay interest to himself. But for the external, there is an interest. And it is placed here, and it is indicated here because it really changes your balance. It really changes your balance, and here the VAT is calculated. In addition, as you know, your financial plan is calculated without VAT. So in order to reconcile it with the cash balance, you need to add the VAT back. So basically, you add the VAT, the difference between the VAT you paid and VAT people paid to you. And this gives you your cash balance. This gives you your cash balance. This is the plan balance. And there is an actual balance which is different from the cash for the amount of VAT. And I will show you, probably this is very important now. We had an assumption. How the cash balance changes over the time if some unexpected things happening, like inflation, like some unexpected political tensions or economic tensions. So they always come with an inflation. So if we had an assumption that cost of goods sold will raise 3% in the future. You remember cost of service 3% raised, 10, 10.30, and so forth. If we change it for 8, there is a prediction that the inflation in Germany will be 8%. It changes your balance. It changes your balance. So your balance was all green. You remember your actual balance was all green. So our plan data is not affected by this inflation, but our actual data is affected. So we had all balance. Wait a minute. Yeah, I need to do it the other way around. Sorry. Since our plan, wait, oops. Wait a minute. Since our plan doesn't include VAT and our actual includes VAT, so there is a difference in cash balance. This is your cash balance. Your cash balance based on your financial plan is positive. It's always green, you see. And if you do actual, so this is a plan, and if you do an actual balance, so if you calculate for the VAT and so on, you just pay more. The more you sell your goods, the more VAT you need to pay. So this is actually a good sign that you pay more VAT. So you have a situation of liquidity gap. So you have less cash on the balance than you need to have before you actually capable of doing business further. So you need to do some loan. You need to do some additional loan. You go to your company and to such companies as Puls, and you tell them, yeah, I need a loan. I need an additional loan. I will show it to you in the third party. And if you take a loan, so the interest you are paying has changed, it becomes bigger. But for this, your cash balance has already closed. So your cash balance, so with the help of such companies as Puls and Montold, you were capable of closing your cash liquidity gap on the short notice. And now we have another 5 minutes. So this was a short demonstration to understand, to give you an understanding of how you create a financial plan, and from this financial plan you create a liquidity plan with the indirect method. So just subtracting and giving back and adding back adding back items you haven't paid to create a real cash flow statement. And then this is the cash flow statement created from the finance plan. And then there is a different cash flow statement created from your real banking activities. Since you pay according to your finance plan, so they need to correspond somehow. But the difference between them is there is a VAT you have to pay, and there are some unexpected things you could never thought of. For example, inflation of 8%. You get your inflation of 8%, you are not capable of doing your payments anymore. You see, your balance, your actual balance is again red. So you need another bank, you need another loan. You need to go to your company, which is this one, and ask for a loan, and they will give it to you. And 15,000 additional loan. And then with this, you are able to pay a couple of months actually, and then you will need to go and to take another loan if you need to pay. So if you have some more liquidity gaps, and if you have to when you have to close those liquidity gaps. And this is an understanding. This gives you an understanding of how do you do your financial plan, how do you liquidity plan out of it based on the financial plan, and how you do an actual liquidity overview, which is from your balance, from your bank statements, which gives you the overview of your real money flows. And now we will look into keep this in mind. We will look into this topic right now for a short video, which gives you an understanding of how Puls works.
Puls is easy. Let's get started. First, you need to connect your business bank account. Simply select your bank and enter your login details. Your bank will always ask for your consent. Once your account is connected, the credit limit is calculated for your company.
So basically, what's
on your application the next business day. Need funds right away? No.
I need to stop it. Yeah. So basically, what is this all about? This is the software which gives you an opportunity to calculate all your cash needs in real time. And in addition, as a bonus, it gives you an opportunity to borrow money from an institution. So there is a group of companies, Montold. This is an investment fund which has a license to give loans to the small companies as yourself, to startups, in order to close those liquidity gaps, to close the disruptions in finance, to be able to keep going with the business. So, and the idea is they have created a software, and the software it's called Puls, and it's managing your liquidity and managing your needs of additional capital. So how does it work? You need to, in order to use the software, you need to switch on your bank account. So like you need to connect your bank accounts to the software. This is what the video tells.
Apply online in seconds. The money will be in your account within the next 24 hours.
So basically, after this, the software sees all your cash disbursements and all your cash in. The software will be able to understand your cash needs and will understand your risks. So because every loan is connected to the risk. So there is a risk, the loan will not be paid back. So the software gives you calculates the risks and gives you an opportunity to borrow money, and gives the company the opportunity to understand how risky your business is. And this is about how much money have you got on your account from the last periods, how much money have you disbursed. So this is about your cash movements, and based on your cash movements, the software calculates your ability to get loans and ability to repay loans. Most important, the ability to repay loans. And this is what is all about.
Puls isn't a bank. Why is getting a loan from us so simple? Good question. It's because we issue loans from our credit fund registered with BaFin. There are no complex forms, banks, or other third parties involved.
So basically, usually if you need a loan, you go to the bank. The bank, the classical banks have really made it difficult to you to get a loan because this is a very bureaucratic procedure. They look into every detail and they require a lot of documents, and somehow at some point you are very exhausted. You don't want this credit, this loan anymore. What Montold is doing, they have created a software which screens your risks and which calculates your need in cash. And they can do it online without any bureaucratic procedures. That's why it's stated here, no complex form, no banks, no other third party involved. So let's listen further.
Let's see how Puls can work for you. First, create a Puls account and connect your business bank account. Puls then analyzes your bank account transactions and identifies how much credit your business can apply for based on cash flow. The more data available, the better your score. Once your credit is approved, you can access the funds. Simply sign the contract and verify your identity by video. Puls then transfers the funds to your business bank account the same day.
So basically, identification is a must. So every regulated financial institution needs to do the so-called AML and KYC procedure. KYC is know your customer procedure, which identifies the real owner of the business, because there might be many companies in between, there might be many structures, but they need to understand who is the real owner of the business. This is the KYC, know your customer, and AML is anti-money laundering procedure. So this understands how legal is your money, how legal is the cash flows on your account. So you will probably need to, in some cases, so like if you're dealing with small amounts of money, nobody will probably require this from you. But if you are dealing with larger sums of money, so you will need to explain a little where does this money come from? Did this money come from? So which are the documents, loan agreements, tax statements, and so on.
The Puls app is super simple to use. Let's look at how it can make life easier and how using it affects your available credit line. After you connect your business bank account, all banking activity is shown on the transactions page. Transactions flow automatically to Puls and sync multiple times a day. So you will.
This is what I told you. This is what I told you earlier. So Puls creates the cash flow statement based on your bank statements. Remember, we had two parts of cash flow statements. We had a cash flow statement based on the financial plan. This financial plan you need to start your business, because nobody will talk to you without a financial plan. So this cash flow statement is derived from the financial plan under the indirect method. You remember we added in all non-cash items and so on. This is not I'm talking about. There is another cash flow statement created from the direct method. This is the cash flow statement you really paid. This is cash you really paid. This is cash from your bank accounts. This is what Puls is talking about in this video. So these are payments you have done in the past, and based on these payments, the company is or the software is able to calculate your risks and your ability to take loans and your requirements and loans.
We'll have a real-time view. Each time, your credit availability is also recalculated. By categorizing transactions, you keep your financials up to date. You also help Puls understand your business better and can increase your available credit.
Yeah, that's what I was talking about. So like these categorizing of transactions, here's the office rent, here's the contractors. Yeah, in our case, there is no contractors, but there is an office rent. There was an office rent in as one, because I summed it up here as one figure. So there is an office rent here, in this figure. Yeah, there are some other expenses also in those which are corresponding to your bank statement, so which you have paid and which can be categorized in this cash flow statement under the direct method, so like created after the real cash movements on your bank account.
Your transactions are grouped by categories on the planning screen.
Yeah,
You're able
this is like we have done it. This is like we have done it here. So like they are categorized. Cash inflow, it's the category for cash inflow. There is a category of disbursement for disbursement of cash, cost of goods sold. There is a category of marketing. There is a category of salaries. This is the same as here. They have just some different slight other names. That's it.
Able to see all the account transactions and current and future balances on the timeline. Puls also makes it easy to understand which balance you have today and in the future on your bank account. For example, if you need to pay the office lease tomorrow, you can.
Yeah, the balance today, it has been told that the balance today. So this is what I was telling you here. You have your cash balance every day. This is the monthly basis, but there is a daily basis as well. We can do the daily basis on this as well. This is what actually Puls is doing. It breaks down those monthly categories, those monthly columns into the daily. And according to the plan, we have enough cash. But according to the actual, where we have to pay VAT as well. So we have not enough. And this is what we will be talking about right now. So if we don't have enough cash, what we will be doing?
Can add a future dated draft payment to immediately see how it will impact your business. Instant and easy.
So basically, wait a minute.
Okay, let's say you have to plan a whole month in advance. No problem. Puls takes care of the number.
Yeah, basically, after connecting to this software, the software gets an understanding of your late payments, of your past payments from the bank accounts, and they create an overview with the actual balance, so what money did you have in the beginning, what have you spent, what have you received, based on days, and then it creates sums. And after it has created the sums, you have your actual balance in the software. But for the future, you need to do it manually. For the future, you need to put your money revenue and money expenses manually, because the software will be developed in this way. So like we'll create overviews, but on the later stage. For now, it automatically reloads automatically your payments from your bank statements, but you need to do projections in the future yourself.
Numbers, so you always know exactly how much money you have each day of the month.
So all your payments are in the future are here, and all your balances after your payments have been made, are reflected here. Basically, all your cash in is reflected here, all your cash out is reflected here, and the actual balance after these have taken place is reflected here as well. And here you see actually there is a disruption. So you have a minus on the account. So how you will deal with this, you will see in a second.
For example, if you see that you won't have enough funds to pay a contractor at the end of March, you can find a solution using the data Puls provides daily. Using the dashboard, you can see that funds will be paid on 4 April. You can then call the contractor to arrange a slightly delayed payment.
So basically, you should have paid your contractor earlier, but after Puls has calculated all your balances, and you see there is no chance to pay it at this day, but later I will get some cash, so I will be able to pay. So can I move it into the future? This is what it is all about.
Not all payments can be postponed. Tax payments, for example. You can use the available credit line to close a cash gap in cases like this. But what if the available credit limit is no longer enough to cover expenses? Don't panic. It's possible to instantly increase your available credit by adding another business account.
So basically, what does it mean? You had only one business account connected, but most companies have different business accounts. The company I'm working for has 2 accounts, and loans are coming into one account, and revenue comes into another account. So there is very helpful to connect really all existing accounts, because this gives you an additional limit to get loans. This is very helpful.
Now you can apply for a credit in seconds. The money will be in your account within the next 24 hours. On the planner page, you'll be able to see the latest transactions, which have increased all future balances. The financial gap now no longer exists, and your dashboard shows your new positive balance. It's possible to add a future dated draft payment in Puls to immediately see how it will impact your balance. The more accurately your scheduled draft payments match the actual payments made, the more credibility your business gains. As a result, your available credit also increases, meaning your business can access a larger amount of credit. Puls enables you to run your business and gain a real-time view of your finances. By building credibility, you simultaneously boost your credit limit, giving you the peace of mind to access funds quickly in a single day. Get started with Puls now to keep track of costs, profitability, and take advantage of predictable balances now and in the future.
So this is actually what I wanted to talk about today. I will be more than happy to listen to your questions and to your suggestions and to discuss it a little further. So please do so.
Yeah, thank you, Anton, for your great presentation. Yeah, other questions? Seems not the case.
So in this case,
I have one.
Please do so.
So you said, so the software has a look to your own liquidity, right? So, or your business development. So depending on this, the amount of possible funds is calculated as well, right?
The idea is they look not into your projections, not into your financial plan. They look into your bank account. They just get connected to your bank account and they see every money disbursement there, every cash in, every cash out. And based on this information, the software is calculating how much of the loan can you possibly repay in the future. You require a lot, but how much can you repay and how much can you get and how much do you need and what your risks are for the company which only gets the investment cash in and doesn't get any operational cash in. So like no sales of products. This is always a question. At some point, investment will stop investing into this business, and this will not be the case. So you need to the best way for the investors to decide in favor of your loans is to show them the positive revenue from your operational cash flow. This is what the software is evaluating and calculating. How viable is the company? If I give her a loan, will it be repaying it to me? So this process, which earlier has been done by the banks with a lot of bureaucracy, with a lot of different steps and annoying procedures, now has been done automatically through this online application. This is what it is all about, you know.
Yeah, I understand. So is it
Wait.
founders
Sorry.
or so, like how many years should you be in business, or how early can you?
Can you ask it again?
So if you are a founder and has maybe have no history of sales, this doesn't seem to be applicable, is it?
The idea is the first round of investment is always the most difficult one. So you need to address your friends, you need to address your people you know, people your parents know. So a lot really, and also you have a chance to go to the accelerators as your company. So there are a lot of accelerators which are supporting those projects, even if there is no positive operational cash inflow, because there is only a plan, there is only an idea, there is only a prototype, but no viable product. So this is actually the most difficult step of the business. You need to convince your investors when you don't have any viable product. You need to do your financial plan very good, because at this place, your financial plan plays the most important role, because they need to trust you with money based only on your idea, and you need to reflect this idea in your financial plan. So this will be your most complicated step to create a good financial plan.
Hi, everyone. May I add just about the Puls? I'm Darina. I'm Gross Market Manager in Puls. You can always also ask questions me about the Puls. I just wanted to add that you just need 6 months of transactions actually to test it. You can even test it earlier, but to receive your credit limit, you just need 6 months of transactions. Yeah, that's it.
So you see, you need at least 6 months. It needs to show a pattern. So if 1 month is not enough, but 6 months is enough to show a pattern. What recurring transactions are taking place? What money is flowing in, what money is flowing out, based on which patterns, based on which structure. I presume these 6 months, you need this. So like the lender needs those 6 months to understand your viability as a borrower.
Okay, thanks a lot, Anton and Karina. Could you share your email address in the chat so people can maybe contact you, or another contact opportunity, maybe LinkedIn?
Great, no worries. Darina will do this. Mm-hmm. And I'm very grateful for such an opportunity to speak up, because I'm thinking about this all the time, and I want to have somebody to share it with, you know.
Thanks a lot, Anton. And we will also upload the video on YouTube so people can watch it later as well.
Wonderful, thank you.
Okay, yeah, I think then we are at the end of this webinar. Thanks a lot for attending, from you, Anton, for showing all the insights and sharing your knowledge. And yeah, hope to have a session maybe soon again with you.
Thank you. Looking forward to it.
Okay.
Bye.
Bye.
Yeah, thanks. Thank you. Bye.